Okay, welcome to Classic Value Investors and Microcap Explosions. This is video number 4 of why I hate the miners. Now, I want to be clear with one thing here. I don't really care if you invest in miners or not. I know that some of you, as I got one comment here, I'm up to eyeballs in the miners. That's fine. But I know that a lot of you out there, you have no idea about the risks. You don't understand the business. You just listening to people like Peter Schiff talking about gold or silver and how the countries are printing money and all that blah, 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 how that's going to translate into higher commodity prices. And the best place to do this is through miners, which is fine, but you don't understand the risks. And now, once you understand the risks, then, or better understand the risk, then you at least have a better idea of what it is that you're doing. Because what you're doing right now is what I did back then exactly, and I got hit really bad and I didn't know why. So I'm showing you how it can go bad, and then with this information you can take it and make your own decisions. But then when something goes wrong, you can cry only to yourself. Okay, in this video we're talking about Atna Resources, which is a company that I was involved with. Not necessarily, I didn't actually own the stock, but I wrote about this company, and there were some people that invested in it, and it got hurt pretty bad. But the story was fantastic. The same type of people that you see invested in it. So let's go ahead and get started. Atna Resources. The idea back then was that the company had 4 assets. Okay, Briggs Mine, Pinson, Reward, and Columbia. And all of these assets, as you can see on the map, they are located in the United States. Very, very safe jurisdiction, right? And one of the mines, Briggs Mine, was already producing and generating cash flows. It was, just to give you, and so, okay, so it was producing and generating cash flow, and the idea was to take that cash flow from Briggs Mine and use that cash flow to put Pinson Underground into production, then put Reward Mine into production, and then Pinson Open Pit, and then Columbia. And in total, the company was going to reach a level of 330,000 ounces of gold per year, and it was going to become a mid-tier producer. So just to give you just some background on these mines. So Briggs Mine, the property was originally put into production in 1995, but in 2004 it was shut down due to the low gold price. Then when the price of gold reached 550 per ounce, the company spent $20 million to reopen it. In 2011, Briggs Mine produced 33,000 ounces of gold at a cash cost of approximately $925 per ounce. In 2012, Briggs Mine produced 37,000 ounces of gold at a cash cost of almost $1,000. So at that time, when the price of gold was around $1,600, it generated cash flows from mining operations of about $25 million. And the market cap at that time was only about 100 million. So if you looked at a market cap of 100 million, the cash flow of about 25, you're like, hey, you know, you're only paying 4 times that. But the company has all these assets that are fantastic, low-risk jurisdiction, and in total, when successful, it will be a 300,000 ounce producer. And if you look at a market cap of 100 million, that is nothing. Okay, so the upside was huge, and on top of it, the company was expecting to produce about 200,000 ounces of gold from Briggs, and which would at a rate of 50,000 ounces per year. So during those, it would last only like 4 years. But during those 4 years, the cash flow from that would have been about 170 million. Again, when you compare it to market cap of 100 million, you can see that it was very, cheap looking. Pinson mine was located in Nevada, and at the time that I looked at it, it was already in production. It had two facets to it: underground and open pit. And underground was producing, but open pit was going to produce later. And because the company didn't have its own facility, actually, remember when I was doing the video on Yukon, Nevada, and I said that the roaster, there was like only 3 roasters in the area, and Yukon, Nevada's roaster was irreplaceable, 500 million replacement cost and all that stuff. So actually, Atna, for that Pinson mine, hired Yukon, Nevada to process its gold. So it didn't have that spending, right? It was taking the ore, underground ore, and sending it to Yukon, Nevada, and Yukon, Nevada was processing it through a tolling agreement. The Reward mine was very close to the Briggs mine. So the idea was that it was only going to cost 30 million to put it into production, because they were going to put the ore and truck it to the treatment facility to Briggs. And it was, once the property was producing, it was going to produce about 35 ounces of gold at a cash cost of less than $600. And from what I understand later, that amount was going to be increased to 75. And then the Columbia project was not close to production. It was at a feasibility and permitting stage, but the PEA that was completed in 2010 projected a 9-year mine life with annual production of 70,000 ounces of gold, estimated at a cost of about $640 per ounce. So what a wonderful opportunity it was. What could have gone wrong? I remember the price of gold was $1,600, and then there was these 3 days, and I can't remember which month, but 3 days, the price of gold declined by $100 each day. So it was like one day, boom, it goes from 1,600 to 1,500. Next day, 1,400, 1,300. So as a result of this, Briggs wasn't producing as much, right? So it wasn't generating the cash high enough to put the other projects into production. And as a result of this, the business plan was turned upside down, right? Pinson Underground was out, Reward was out, Pinson was out, Columbia was out. And as you can see, the stock price at that time was about $1.20. And from that point, it declined to about 10 cents per share. Now, also, a couple years earlier, because shareholders never want to dilute themselves, the company took on, I think it was about $20 million of debt, and Sprott was involved in this. And as you can probably imagine, at some point, the payments came due, the price of gold was lower, the production wasn't producing as much, but the lenders still wanted to get their money. So what ended up happening is that the company had to go into Chapter 11 bankruptcy. All the assets were given out to the various lenders. The stock went to zero, eventually got delisted. The shareholders got absolutely nothing. So fantastic opportunity. Started off with cash flowing mine, making a lot of money that was going to be used to put the other ones into the production. The market cap was over 100 million, no problem. Gold price just declined a little bit, and this was enough to kill this company completely. I was extremely bullish on this company because gold, the countries are printing money, gold had no way but to go up, but just a little bit of decline in the gold price killed this stock. A lot of people lost money. I was getting emails how I will never forget this email. This guy said that by recommending Atna, I set him backwards financially by at least 10 years. So think about that, how wonderful I felt about this. But you might think about, oh, it's just this one company. It was just one after another, one fuck up after another fuck up, after another fuck up. And how many times can you excuse and say, oh, this time it was this mistake, it was the management, or it was this asset, or well, you couldn't have predicted the permit or not permit. Eventually you realize this business is horrible. There's so many risks in it. And no matter how much you understand the situation, you can't control the commodity price. It can go up and down anytime, no matter what happens, because it can get switched like this. And when your companies have just a little bit of that, we're talking about $20 million worth of debt here. $20 million worth of debt bankrupted this company. And if this company ever achieved the production of 300,000 ounces, it would have probably be worth $3 billion. So there you go. A potential of $3 billion was completely destroyed because of a $20 million debt. Let that sink in. $20 million debt and a little bit of a decline in the price of gold. So this is video number 4. I hope you enjoyed it. I still have a list of more, and you'll see, more fuck ups and how they are possible in this sector. So thanks for watching.